everyone. Welcome back to Corporate Tax Webinar Series Part 4 by RBS Auditors. With immense pleasure, we welcome you once again to today's webinar series presented by RBS Auditors. Your presence here is greatly appreciated and we are so excited to have you all in this session of today's webinar. I am Rinia Matthew, host for this session, and we will be discussing about offset of tax losses, relief of double taxation, withholding tax, and foreign tax credit. Before we proceed, let's have a moment to our journey together we have had so far. I hope you all enjoyed our previous videos about basic concepts of corporate tax, decoding of free zone person, and related parties and connected persons. If anyone missed, we have uploaded those videos in our YouTube channel. So please watch, do subscribe, and post your valuable comments and thoughts over there. Also, you can share your feedbacks through our Google review. For that, we have added that QR code in this session. So you can just scan that one and post your reviews. We invite you to actively participate in this session. So if you have any queries, you can just post it as a comment below. So we will be addressing at the end of this session. In this session, we are going to explore some really important topics like how the tax losses can help in the future. Also, how to deal with paying taxes in different countries without getting double taxation, and also a clear-cut picture about our foreign tax credit, withholding tax, like that topics. These are like foundation blocks about the corporate tax which have introduced now, and we are sure that this will give you more knowledge and clarity regarding these areas and it will help in your future. So now I invite today's speaker, Mr. Sijin Kerevi, for this session. Over to you, sir.
Thank you, Renia, for your brief introduction. Ladies and gentlemen, good afternoon, good evening. This is our fourth webinar series relating to offset of tax losses, then relief from double taxation and withholding tax. In this webinar, we are mainly concentrating on how to offset your tax losses. Second part is a relief from double taxation, and third part is how the settlement, how the tax payable will be applicable. So let me share my presentation, then we'll go through one by one. So the agenda for the day, first one is a tax loss relief. Second, we'll discuss about the transfer of tax losses. Third one, limitation of tax losses and carry forward. And relief from double taxation, then exempt income, then foreign tax credits, then calculation and settlement of corporate tax, then withholding tax, and some practical example relating to all these sections we'll be discussing. So, tax loss relief. Article 37 talks about tax loss relief. What exactly tax loss relief? We'll just have a look at. First one, tax loss relief. So tax loss relief you will get based on the taxable income. So whatever the taxable income achieved during the year, that year you can offset against the tax loss. There is a condition saying that 75% of tax loss, 75% of taxable income only you can set off. That means, for example, 100,000 is the taxable income for that year. That 100,000 into 75%, that means 75,000. So if any tax loss, anything is there, 20,000 tax loss is there, then that 20,000 will be carried forward based on 75% of taxable income. So second condition, it's a 75% of taxable income. And third point, cannot be claimed for loss incurred before commencement of this act. And the fourth point must be set off against the taxable income of the subsequent period and balance carry forward. And fifth point, exempt income or loss. It's not eligible for any exempt income you cannot do. So first paragraph, it says about Article 37. One is relating to taxable income. Taxable income loss can be set off against the taxable income of the subsequent period. And second condition, out of second part, it is only 75% of taxable income should be set off against taxable loss. We will look into this part in a detail with the example, then we'll get an idea. And the third condition, loss cannot be claimed before commencement of act. That means if any loss has incurred, then you cannot claim this tax loss against that one. And fourth condition, that must be taxable income. Subsequent periods before carry forward, that loss should be offset. Then only you can be a carry. So what are the cannot claim tax loss? One is before the date of commencement of tax. Any loss incurred before commencement of tax, you cannot claim. And the second one is a loss incurred before the person become a taxable. If the person is not registered, so whatever the loss incurred, that you cannot claim. Then third one, it is loss incurred from any activity, exempt income activity. In that case, you cannot claim that tax loss. So we'll just see an example. Transfer of tax loss having 75% of ownership or more. A company ABC has a tax loss in the year 2025 an amount of 650,000. It achieved a profit of 400,000. So 400,000 is a profit, and carry forward loss it's 650,000. What is the amount of tax loss offset and carry forward in the year 2026 and 2027 respectively? All the facts remain same, except taxable profit of ABC AD is 800,000. So we'll look at one by one example. First one is a tax profit 400,000 less 0% tax 375, balance it's 25,000. So 25,000 only it's available. So how the eligibility will be calculated? Whatever the point I disclosed in the 75% of taxable income, in that one 75% of taxable income, 75% of tax profit. That means 400,000 into 75%. That means 300,000 it's eligible. So how much is the loss? It is 650,000 loss is there. So eligible, it's a 300,000. 300,000, how it is calculated? 400,000 into 75%. So 300,000 eligible. Out of this, how much is allowable? That means the total taxable profit is 400,000. Then standard deduction 375,000. Then balance 25,000. This much amount you have to pay. 25,000 into 9%. But you have already loss is there. Then out of that, because of that loss, out of 650,000, 25,000 it's reduced, then balance 625,000 will be transferred. That means 650 less allowable for this year 25,000, because only 25,000 is allowed, because here it's a balance, it's a 400,000 income, then standard deduction 375,000, then balance it's a 25,000. Let's see the second scenario. So the company ABC, the calculation with the tax profit, it's 800,000. Instead of 400,000, it's 800,000. So loss percentage, 0% standard deduction. In that case, 375,000, it's a standard deduction. Then balance 425,000, it's allowable amount. Then first we'll calculate eligible category. Eligible category, how it is calculated? 75% of taxable profit, taxable income. Tax profit is 800,000. 800,000 into 75%, it's 600,000. So this much amount is eligible. Out of this 600,000, then allowable for this year, because 425,000. Then carry forward, it's 225. So this is a second scenario. So tax profit is 800,000. 375,000, it's a standard deduction. That means up to 375,000, it's a 0%. Then above 375,000, it's a 9%. So 375,000 first you deducted, then balance 425,000. This much is available. Out of this available eligibility category, it is 75% of taxable income. 75% into 800, that means 600,000. So out of 600,000, it's eligible is there, but we have only 425, it's available. So straight away, full amount you will get deduction in that year. Then that year, no need to pay any tax. Then balance part out of 650,000, balance part 225 will be carried forward to next year. So this is the calculation relating to relief under 37, Article 37. And the third point is, if all the facts are remain same, then if it is an exempt income category, the activity is relating to exempt income category, in that case, you cannot claim any tax loss. Transfer of tax loss. So company A, it is located in UAE, company B is located in UAE. So what are the main conditions in order to transfer your tax losses? Both entities must be UAE resident. So if it is a company A, it's situated in UAE, company B is in a foreign country, then you cannot offset any losses. If both the company is situated within UAE, then you can offset tax losses. And another condition, it is a 75% or more in another company. So 75% of shareholding it must be there, then only it is possible. And first condition, if you see, it's a juridical person. That means only company can do this tax loss set off. If any natural person, for example, sole establishment, it is treated as a natural person, in that case, you cannot do any tax loss offset. Another condition, it's ownership status. From the beginning to till the end, all the 75% must be there. So in between, there is a shareholding change or anything. If it is a shareholding change has been reduced from 75% to less than 75%, for example, 74%, then in that case, you cannot do. That means from the beginning to till end, 75% shareholding structure in the another company, either direct or indirect. These things we are clearly discussed in the previous webinar. For example, company A situated in mainland and company B situated in mainland. Company A having 100% ownership in company B, and company A having a 20% ownership in company C, and company B if owning 80% ownership in company C. In that means indirect ownership. In that case, company A can do offset because company A is 100% owned by B and indirectly owned by C. So that's why it is clearly says about the second category, either directly or indirectly. And neither the exempt person nor the qualifying pre-zone person. If a qualifying pre-zone person is there, then you cannot take this tax loss, transfer of tax loss. It's not possible. Then they have to prepare a financial statement using a same accounting standard and the same financial year. And the other condition, tax loss transferred shall reduce the taxable income of the relevant period. That means whatever the income calculated for that period, first you have to reduce the tax loss, then you have to calculate the rest of the things. You can carry forward the tax loss. Then tax loss offset shall not exceed the amount as per the article 37. As per the article 37.2, it says about 75% of taxable income. So whatever the taxable income for that period into 75%, that much only allowable for that year. That means it's not allowable for entire year. If it is 100%, 100,000 is the taxable loss, 100% is the loss for that year, then taxable income is 400,000, then 400,000 into 75%. That is the maximum you will get in the first year. Then whatever the rest of the amount, you can transfer to the next financial year. So we'll see one example. The data for a two company, both the company following same accounting standard. One condition, previous condition, it says about the accounting standard, they have to maintain same books of accounts. Company A, company PQR has a taxable loss of 150,000 in tax period 2024. Company ABC has a taxable income of AED 600,000 and hold 90% of interest in PQR in tax period in 2024. So this condition, 75% ownership, it is already covered because it's a 90% interest. If this 90% interest, whether they can create PQR and ABC, whether they can create a tax group, it is not possible. Minimum 95% is required. But they can create a qualifying group. Qualifying group means 75% or more. We have discussed these matters in the previous webinar. So in case you have any doubts, you can just look at that webinar series. And can PQR transfer its taxable loss to ABC for financial year 2024? If yes, then what will be the amount of tax loss transfer? So taxable income of ABC, it's 600,000. Company ABC has a taxable income 600,000. Tax loss PQR as per Article 38, 150,000. Straight away you will get a deduction. We'll see how we'll get a deduction. So what is the condition? Taxable income 600,000 into 75%, automatically it is covered. So straight away full amount you will get deduction. That's why 75% is 600,000. It's a 450,000. It is eligible, but you have only 150,000 is the loss. So total taxable income ABC, it's a 600,000. Tax loss, it's a 150,000. So eligible category 75% of 600,000, 450,000 it's eligible, but actually only 150,000. So only 150,000 straight away you will get a full eligibility. Now let us look at limitation on tax losses carry forward, Article 39. So what are the conditions? It's we have discussed about the first part, Article 37, 38, then Article 39. It is relating to limitation on tax loss carry forward. What are the main conditions? The condition for ownership change, the same person must have at least 50% of ownership interest from the beginning of the tax period in which loss incurred till the end of the tax period. That means, for example, you have a ownership interest, it's 75% ownership interest is there, but if you want to do a carry forward of the loss, then the main condition, minimum 50% ownership interest must be there from the beginning to till the end of the tax period. In that case, only you can do a carry forward. Otherwise, it is not possible. And this carry forward, it is not applicable for a listed companies listed in the stock exchange. And the change in the ownership interest is more than 50%. Taxable person must conduct a same or similar business activity. For example, company situated in a mainland company, then they are changed their ownership status. Then they changed their ownership status in the sense that they have transferred their business to another company. In that case, then what are the conditions? Their main activity must be same. If the activity they have not changed, then they can do it. If the activity it's the same activity they are continuing, then you can do this option. Otherwise, it is not possible. For example, company having an activity like a consultancy business, and that consultancy business has been changed to some other business, project management business, entirely different from the initial one. In that case, you cannot avail this option. So the same activity must be continued. That means the use of asset must be same, continued usage of the same asset. Then no significant change in the identity or business operation. Then research and development, changes in the development and exploitation of asset, service, process, product and methods. All these things, it should not be changed. In that case, only it is possible to do this option. Now let us look at relief from double taxation. So first we will see what is a double taxation. Double taxation means you have paid some taxes in one country and same income is taxed in another country. In that case, a double taxation, it will be come into the picture. That is imposition of tax on same income in multiple jurisdiction. In that case, there are two forms are there. One is the same person in different jurisdiction. That means a taxation of the same income in the hands of same taxpayer by multiple jurisdiction. In this case, double taxation will be involved. For example, UK subsidiary firm pays a royalty to Indian parent company. Indian company taxed on its global income based on residence rule, and royalty is taxed in UK under source rule. This we have already discussed what exactly relating to resident-based taxation and resident-based taxation and rule-based taxation. Under resident-based taxation, under this scenario, resident-based taxation, it will be taxed on the base of the global income. That means a resident country, whatever the company registered in that country, plus whatever the income. For example, you have a subsidiary. In that case, whatever the income received from the subsidiary, you will be included in the total income. That is the resident-based taxation. And what about the source-based taxation? Source-based taxation means income received from which country that income is received. For example, UK cases, UK subsidiary income is received from UK company. So UK company will be taxed on the base of source base. But in Indian company, because our parent company is situated in India, it will be consolidated against UK company. So consolidated financial statement will be prepared. In that case, global income based on residence rule, it will be taxed. So it is a same person in but a different jurisdiction. That means one in UK and one in India. And the second scenario, economic double taxation. In that case, different person but a different jurisdiction. That means same income in the hands of different taxpayers by multiple jurisdiction is known as economic double taxation. For example, dividend is taxed in the hands of corporate and in the hands of shareholders. For example, same area, UK subsidiary. The same cases, the dividend is already taxed in UK, and whatever the dividend paid to the Indian parent company, in that case, automatically that dividend will be again taxed in the hands of the shareholders. So India is a shareholder, one of the shareholder. In that case, again, that amount will be taxed. This case, for example, UAE case, a dividend is exempt, that we will discuss in detail relating to that part. So these are the two areas, the double taxation it is coming. So because of this double taxation, one is relating to the country-wise double taxation, one in India, then one in UK. So you will get a double taxed. And similarly, second category, it is relating to person wise. One it's as a corporate and the second as a shareholder. So in the hands of shareholder it will be taxed, and in the hands of the corporate it will already taxed, because a dividend and whatever the income, first you pay the tax, then you can distribute the dividend. So these are the two forms, how the double taxation come into the picture. So what are the benefit for avoiding double taxation? Once it's a double taxation agreement is generated on the basis of a double taxation agreement, the countries have been entered into different agreements. On that basis, automatically the double taxation will be eliminated. So free flow of trade, then avoid double taxation, legal and physical certainty, exchange of technology, then mutual exchange of information, non-discrimination. All these things are the benefit of DTA. So once the DTA plays into the picture, then automatically this double taxation will be relieved, and the tax transparent situation will be come into the picture. So let's see what are the measures to avoid a double taxation. So types of DTA, there are two types of DTA is there. One is a comprehensive and the second one is a limited one. Comprehensive DTA means it will cover all type of incomes like salaries, interest, dividend, capital gain, all it will be covered. UAE has assigned comprehensive DTA with many countries like Austria, China, France, Germany, UK, USA, and the full list is there. If you just look at the MOF website, you can download the entire list from the MOF website relating to which country UAE has signed the DTA between the different countries. And the second category, it is a limited. So type of DTA, one is a comprehensive. It covers all type of income. And the second category, it is like a limited. In that limited category, in that only limited area of the incomes, such as shipping, aircraft, profit, or royalty, technical fees. So shipping business, aircraft business, whatever the profit generated from those business, it will be covered under limited DTA. And royalty, technical fees. For example, shipping and aircraft business, profit between India and Pakistan, it's a 0% in both countries. Limited between then royalty cases, India and UAE, it is 10%. This is the type of DTA, limited and comprehensive methods. So if you just see DTA with the UAE list extracted, it is just for your reference, I just extracted some of the DTAs only. It's not full list. It's a total 139 countries are there. You can just visit the MOF website, then you can download this list. So one is Egypt. You can see the final signing date, ministerial decree, then federal decree dates. In between the fire alarm. Now, let us look at the language used by treaties. So one is contracting stake. If you see the DTA, if you just download the DTA between the different countries, then we can see the whatever things used in the DTA. So one is relating to contracting state. That means a country country in which a treaty is ended. Second category, it's a state of residence, country where the person resides. Then third category, state of source, country where income arises. Then fourth category, enterprise of contracting state, any taxable unit including individual. That means one first case contracting state means country which enters into treaty. That means, for example, UAE is contracting state of the UN National Convention. In that case, then UAE will be a contracting state. So enterprise of the contracting state means any taxable unit. So that means any company situated in UAE that will be treated as enterprise of contracting state. And permanent establishment means any fixed base of enterprise, any company situated in the respective contracting state, either a branch of foreign company or fully owned subsidiary company. Income arising from the contracting state means income arising in the state of source. So these are the terms used in DTA. If you download the DTA between UAE and UK or any other country, then you can see they will clearly mention about the contracting state, state of residence, state of source, enterprise, then permanent establishment, income arising in the contracting state. So these terms must be understood in order to understand the DTA terms. Otherwise, it will be very difficult to understand what is the concept they are saying about. There are DTA international collaboration. DTA models, there are three models are there. One is OECD model tax convention on income and on capital. Then UN model is the UN model double taxation convention. Then US model tax convention. UAE has adopted OECD model tax convention. But again, UAE has also signed multilateral convention implement to tax BEPS action points. This is we have already discussed in the first webinar series. In that case, the exchange of information, BEPS action point, exchange of information has been UAE has signed with different countries. Now, models DTA, international collaboration. So there is a different type of models are there. One is a comprehensive agreement for all incomes with all multinational companies. Multinational companies means 750 million euros turnover. In that case, multinational companies will be treated as. Then a limited agreement with Lebanon, Pakistan, Afghanistan, etc. covers only certain type of incomes. That means UAE has signed a limited agreement with Afghanistan, Ethiopia, Iraq, Pakistan, Somalia, and Yemen. So depending upon limited agreement, it is purely on limited income category that we have already discussed in the previous slide. And a tax info exchange agreement that is called a TIA. So in this TIA, it's with BVI, Cayman Island, Bermuda, Bahamas, etc. And UAE signed TIA with other countries also like Australia, Canada, Finland, France, Germany, India, Japan, Norway, Sweden, UK, USA. So what exactly TIA it is like, whatever the tax information it will be, tax information will be passed to the respective countries. Then last one, it is with Nepal, limited multilateral agreement with Nepal, Bangladesh, and in that case, with more than two countries, then limited multilateral agreement will be executed. Now let us look at a relief from double taxation. Type of relief: unilateral relief, then bilateral relief. There are two types of reliefs are there. Unilateral relief, then bilateral relief. Unilateral relief means applicable where DTA does not exist. So if any country, for example, UAE is not having any agreement with another country. For example, if you take a UK, if UAE is not having any DTA agreement with the UK, in that case, then unilateral relief will come into the picture. Then second one is, in that case, unilateral relief only allowed under domestic tax laws. So if unilateral relief is there, whatever the domestic tax law, that will be prevail. That means enabling portion will be based on that respective country's domestic tax laws. Bilateral relief, then applicable where DTA exists. So bilateral relief, it is like that wherever there is a agreement between the countries, then bilateral relief will be come into picture. Then enabling provision, then mechanism, Article 23. Article 23, it's discussing about elimination of double taxation. Now let us look at method of elimination of double taxation. Different methods. One is a direct method, then indirect method. So direct method, there are two methods. One is a credit method, and the second one is a exemption method. Exemption method. Then under credit method, there are two methods again: ordinary credit method, then full credit method, then exemption method, full exemption method, exemption with a progression, and indirect method, underlying tax credit, then tax sparing. We'll discuss with the problems to understand these methods. So main division, one is direct method, then second one is indirect method, then credit method, exemption method, underlying tax credit method, tax sparing. So different method of elimination. One is direct method. So in direct method, there is a two type. One is a full exemption method, then exemption with the progression. So full exemption method means it's a totally exempt. So whatever the tax paid, you will totally exempt that income itself. And partial progression exemption method means exempted subject to effective tax under exemption with progression. That means you will be calculating on effective tax. That means whatever the foreign income plus UAE income, that will be clubbed, then total global income will be calculated, then global income will be calculated, and tax will be calculated on that global income. Then you will consider how much is the effective tax. That will be, you will get an exemption. So one is a full exemption. Full exemption means 100% you will get an exemption, and with progression you will get partially, you will get an exemption. So we'll see the with example. First case, income earned in the country of residence. It's 1 million. Under full exemption, we will discuss 1 million. Income earned in the source country, 300,000. If there is no exemption, 1.3 million will be calculated based on the global residence rule. Then automatically tax liability 83,250. 83,250, how it is calculated? 1.3 million minus 375,000. Then balance amount into 9%. So effective tax will be under progression method, it will be applicable. So total income considered for both the methods, 1 million. Then if you pay based on the tax on 1 million, 56,250. So under full exemption method, this amount, that means 300,000 into 9%, 27,000 will be fully exempt. So in this case, 27,000 is a fully exempt. Under progression method, country of residence, it's 1 million. Income earned in the source country, 300,000. Total, if there is no exemption, you have to pay 83,250. In this 83,250, you will be calculated what is the effective tax rate. Effective tax rate is 83,250 into 1.3 million. 1.3 million is the total global income. So effective tax rate is 6.4. So that 6.4 will be applied on 1 million. 1 million, it is whatever the resident, UAE related residents, they have total 1 million taxable profit. In that 1 million, it will be applied total 64,000. So the with progression 19,250 will be reduced. If there is no exemption, then they have to pay 83,250. Because of DTA exemption, they have to only pay 64. In this case, under full exemption, it is 83,250. But they have to only pay 56,250. That means full 27,000 fully exempted. 27,000, how it is? You got it, 300,000 into 9% straight away. So 23,000 fully exempted. Second method, full credit method. So first part we have discussed about a full exemption, then progression. The second part, full credit and ordinary credit. Full credit means the country of residence allow full credit for tax paid. The first part, it is based on the income, but the second part, it is based on the full credit on tax paid. So it's entirely based on tax. And ordinary credit, again, it is based on effective tax rate. Whatever we are discussed in the previous slide, the same level it is applied. For example, full credit method. The same example, 1 million is the country of residence, 1 million is a taxable income earned in the source country. It is a 300,000, and total income 1.3. Tax paid in source country, for example, tax paid in the respective country, it's a 5% and 15,000, 300 into 5%, 15,000. This 15,000, it is paid in the respective foreign country. In that case, 1.3 million global income, total tax liability 83,250, and you will get deduction of 15,000. That is a full credit. 15,000 you will get a deduction. You have to pay only 68,250. So this is the full amount, whatever the tax paid in the respective foreign country, you will get a full credit. So this is called full credit method. Under ordinary credit method, the same example, 1 million and 300,000, 1.3, then tax paid in source country, let's say 20% is a tax rate in the respective source country, 60,000. Then 83,250 will be effective, 83,250 into divided by 1.3 million. Its effective tax rate is 6.4%. In that case, relief will be 6.4% on source country income. 300,000 into 6.4%, 19,200. Then 19,200 you will get relief. So net tax liability will be 64,050. So this is the method used. Next one, different elimination method, indirect method, tax sparing, and underlying. So first we have already discussed a direct method under full exemption, then a partial exemption, then ordinary credit, then a full credit method. So next one, it is relating to tax sparing. For example, resident country A invest in country B. Okay, so country B main concept is that they are attracting a lot of investment from the foreign nationalities, foreign national or foreign company. So resident company invest in country B, and country A gets interest income from country B, and in that country B, interest income is there is no tax on interest. So in that case, how the tax sparing is calculated? For example, you have a country A, there is a country A, then country A invested in country B, whatever the interest income received from whatever the investment, interest income received, it will be exempt in country B. So how it will be calculated? If that interest income is taxed in country B, then what will be the taxable rate? So for example, in country B, interest income, if it is a taxable, in that case 12.5%. In that case, that 12.5% on that income, you will get a deduction. That is called a tax sparing. That means taxpayer would get a credit of an amount which would have been paid in the source country had there had been an exemption on said income under the domestic tax law. So under domestic tax law, if they have paid that the same income, what will be the tax rate? That amount you will get a deduction. So that is called tax sparing. And underlying method, indirect method, then underlying tax credit. Underlying tax credit, it's almost a similar one. Credit on account of a foreign tax paid. For example, UK company declare a dividend, then whatever the dividend, whatever the tax paid on dividend, that percentage you will get a deduction. So underlying profit, or how much is the whatever the profit distributed, in that case, or how much is the tax paid, that you will get a deduction. So like that, underlying tax credit method. So these are the major methods used. So one is relating to ordinary direct method. Second one is indirect method. Then direct method, it is you will get a full exemption, then partial exemption, progressive exemption, then full credit, then partial credit, then indirect method, tax sparing, then underlying tax credit. So these are the different methods for elimination of whatever the tax paid in the different countries. Now we'll look at the major areas. One is exempt income category. One is a profit distribution. Then participation exemption. Then foreign PE exemption. And then non-resident person operating aircraft or ships in international transportation. So we'll discuss this part in detail. So a lot of people are asking about how the dividend, whether it will be taxable or whether it will be taxable in the hands of the shareholder. If it is from a foreign company, then what will be the impact? If it is a holding company situated in the mainland, what will be the impact? If it is a company situated in a qualifying free zone, what will be the dividend impact? So we'll discuss in detail. So domestic profit distribution under Article 22 exemption. So what are the exemption? It is any dividend and other profit distribution received by a taxable person from a UAE resident. So it clearly says about the UAE residents. So if it is from the foreign country, then it is not possible, including dividend received from qualifying free zone person. So these are the conditions for domestic profit distribution, Article 22 exemption. So whatever the dividend received from a UAE resident, it will be exempt. It's only UAE residents. So we'll see one example. Company A is set up in mainland. Company A, it's a mainland company. Then Company A holds 100% shares in Company B. Company B is situated in UAE mainland. Then Company C, it's a foreign entity. Company C, it is a foreign entity. And Company A has a branch in a Dubai branch. So under this scenario, what will be impact? So dividend, interest, management fee, royalty, whatever the amount received by the holding company from the respective company, what will be the impact? For example, dividend received from company B and similarly dividend received from company C. So company C, it's a purely a foreign entity. Company B, it is a mainland entity, and company branch, there is another branch. So what will be the impact for the dividend income received? So dividend from company B, it is a mainland company, so automatically exempt under Article 22. So Article 22, it says about whatever the dividend income received from the UAE residents. So that will company B, it is a mainland company, it will automatically exempt. So whatever the dividend income from company C, so company C, it is situated in the foreign entity, automatically it will be taxable, because why it is only it's a UAE mainland company, only you will get exemption. Then management fee, royalty, interest, whatever the income, either B or C, automatically it will be taxable. So only dividend, it will be exempt. Now let us look at the same holding company situated in a free zone. So free zone in the sense, a qualifying free zone. It's whatever the condition following with all conditions we have already discussed in the previous seminar relating to qualifying free zone. If you are not visited in that one, you can just check in our YouTube channel, full details relating to qualifying free zone. So company A is situated in a qualifying free zone, and company is set up in a designated free zone, qualifying free zone, and a designated free zone. And company A holds 100% shares in company B. Then company C, it is 100% shares in company C. Company C is situated in a foreign country. And company A has a branch in the mainland. Then what will be the impact? Whatever the interest, whatever the dividend, interest, or management fee or royalty received from the company B. Company B, it is situated in mainland. Company A, it is in free zone. And dividend, interest, management fee, and royalty from a foreign company. That means the company C, it is situated in overseas company. Then what will be the impact? And company A owns intellectual property also, so automatically royalty will be involved. So holding company. So first one, dividend from company B. So company B is situated in mainland. Then company A, it is in a qualifying free zone. So what category? It is a qualifying activity. It's a holding of shares and security. So there are list of 13 qualifying activity. It is there. One of the activity, holding and shares of activity. Whether it is treated as a qualifying income, yes, it is treated as a qualifying income. Then taxability exempt under Article 22 because it is dividend is already exempted. So we have clearly mentioned one condition, including qualifying free zone. So you will get an exemption including for a qualifying free zone. Dividend from company C. Company C, it is situated in a foreign country. So whatever the dividend received from a foreign country. So whether it is a qualifying activity, it is a qualifying activity. Holding of shares and security, it's a qualifying income. Whether it will treat it as a qualifying income, yes. Then what will be tax liability? 0% tax liability. Why this one? Because the company A is situated in a qualifying free zone, and company A, it's a holding company, and a holding of shares and securities, it's one of the qualifying activity in the qualifying free zone. Then you need not to pay 9% tax. It's a 0% corporate tax. If you see the previous example, it will be entirely different. It is a taxable at a 9%. And interest income, whatever, whether it is a qualifying activity, yes, it's a treasury and financing services to a related party. So it is a qualifying activity. Then qualifying income, yes, it is a qualifying income. Then taxability 0%. Management income, so it is a headquarter business. So it is a headquarter services to RP. Then qualifying income, yes, qualifying income is, yes, a taxability 0%. Then royalty income. So third category, royalty income. Whether it is a qualifying activity, there is no qualifying activity for a royalty income. It's specifically mentioned. It is an excluded activity. That means ownership or exploitation of IP, intellectual property right. It is an excluded activity. In that case, then whether it is a qualifying activity, it is not a qualifying activity. If that income is within de minimis threshold, then it will be 0%. If excess, that means a qualifying free zone, then entire income will be taxed at 9%. So royalty income, it is depending upon how much is a de minimis requirement. You can check the previous webinar, what is a de minimis requirement in detail. And the fourth one, it is a last one, it's a profit of a mainland branch. Profit of a mainland branch, it is not a qualifying activity. It's straight away. It's not applicable. Then it is a qualifying income, no. But a CT, it's a 9%, not included for calculating de minimis threshold. That means a 5% calculation. This profit of the main branch is not included. It's a 9%. So these are the main difference between dividend received from a holding company. If you are situated in a qualifying free zone, if you are situated in a mainland company, what will be the impact? And you have to see what's the activity. So holding company means just investing in a different entities, and you are not carried out any activity, but it's only holding of shares or security in the respective entity. So in that case, whether if it is in a foreign country or if it is in a qualifying free zone, what will be the impact? So hope that you understood this concept in detail. So next one, participation exemption, Article 23. So one is a dividend or other profits distribution received from a foreign participation. Then gain or loss derived on transfer or sale of disposition of participation income, then foreign gain or loss, then impairment of gain or loss. So whatever the income received, dividend or other profit distribution received from a foreign participation, in that case, that will also exempt. That means either you are received from a foreign participation, that means you are invested in another country, then that investment must be, interest means 5% or greater ownership interest in shares of the capital of jurisdictional person. That means only in the company. So if you are invested in a sole proprietorship or something that it's not possible only in the company, then you will get a participation exemption. Participation exemption means 5% or greater. So if it is if it is a less than 5%, whether you will eligible, now still you will eligible, but the investment is more than 4 million. If investment is more than 4 million, whatever the fund invested in the respective country, then you will get a participation exemption. So whatever the dividend or profit distribution received from the foreign participation, you will get exemption. Article 24 is talking about a foreign PE exemption. That means a resident taxable person may opt not to include foreign PE. So you have a foreign company situated in a mainland. In that case, you are requesting to the FTA saying that I don't want to include that foreign PE income while calculating the total taxable income. So what are the conditions? So you will get a foreign PE exemption under Article 24. But what are the conditions? Foreign PE must be taxed at 9% or more. So for example, another country, it's a foreign PE, it's a tax, it's a 5%, then it is, you will not get this foreign PE exemption. If, for example, if you are taking Oman tax rate is a 15%, in that case, here UAE tax rate is 9%, straight away you can apply for foreign PE exemption. In that case, it will be taxed in that jurisdiction. So only one condition is that you have to opt not to include foreign PE income. So what are the conditions? If once you opt a foreign PE income, then whatever the loss of the foreign PE to be ignored, then you cannot consider loss carry forward, or you have to offset with the other entities' income. It is not possible to do. Then income as well as associated expenditure of the foreign PE not to be considered. So once you are not to include the foreign PE income, then automatically whatever the income or whatever the losses you should not consider. Then whatever the transfer of assets and liability between the resident person and foreign PE must be at a market value. That means you cannot transfer at cost. Then no foreign tax credit in respect of foreign PE to be availed. So if already foreign PE it's already there, then you will not be eligible. Then other condition, each of the foreign PE shall be treated as a separate independent person. That means each people will be separately calculated. Then you will be calculating the foreign PE incomes. Then exemption under this rule shall apply to all foreign PE of the resident person. Now let us look at a non-resident person operating ships or aircraft. You will get another one more category. So in that case, non-resident person operating ships or aircraft. For example, Qatar Airways is generating income from UAE. In that case, the entire income, whatever the entire income in the international transportation will be exempt. That means international transportation of passengers, livestock, mail, parcel, merchandise, goods, whatever the international transaction are relating to that income, it will be exempt in UAE, but it will be taxed in the respective country. So leasing, the second category, leasing or chartering of ships, then leasing of equipment of ships or aircraft. In all this case, then the income will be whatever the income generated by this entity will be exempted. So the condition, non-resident person will exempt, but the main condition, taxable in the country of residence. So this company, the ship owners or wherever the company registered, it must be registered in the respective country. For example, Qatar Airways, it's registered in the Qatar, then it will be taxable in that country. So the same exemption must be provided for UAE companies also. In that case only it is possible. That means the country of the foreign airline or shipping company would grant a similar exemption to the UAE operators. So if UAE operators are given the similar exemption, then you are eligible to claim this exemption. Now we'll see calculation of settlement of corporate tax. How corporate tax must be settled. So first, corporate tax settled by using withholding tax credit. Whatever the withholding tax, whatever the tax calculated in that one, you first you can offset against withholding tax credit. We'll discuss in detail that part. Then whatever the after offsetting withholding tax credit, then whatever the taxable person foreign tax credit, whatever the foreign tax credit means whatever the tax paid in the respective foreign country, that will be deducted. Then whatever the residual amount, then any other relief, anything is there, then you will be reduced by that much amount. Then finally that amount will be corporate tax payable. So first will be withholding tax credit, then foreign tax credit, then after whatever relief anything is that you will get a relief, then final corporate tax payable. That means the taxable income corporate tax, then up to 375 0%, above 375 9%, total tax liability, then withholding tax. At present withholding tax is 0% in either resident payment or non-resident payment, then foreign tax credit, then final CT will be payable. What are the currency used? It will be AED and central bank applicable. If the currency used by any other currency, then it's a central bank applicable rate. Whatever the central bank applicable rate, that will be used. Then withholding tax. At present it is a 0% withholding tax. Withholding tax means whatever the payment paid to the non-resident or the domestic or cross-border payment like interest, dividend, royalty, or any other payment, it will attract withholding tax. As of now, UAE has got withholding tax 0%. So as of now, withholding tax credit, it will not be there because it's a 0%. So it's a clearly mentioned 0%. It's not saying about exempt. They can increase whatever the percent, 9%, up to 9%, they can increase. So what is the condition? It's lower of whatever the withholding tax deducted or corporate tax due, whatever the lower of these two amounts, whatever the lower amount, you will get a deduction, and whatever the balance amount, you will get a refund. Foreign tax credit means whatever the for example, company situated in USA and foreign tax it's already paid 10,000 and the total tax payable in UAE it's 15,000. Then you will get a net of that 15,000 minus 10,000. You will get a net of that 5,000. So net tax liability you have to pay 5,000. So the foreign tax credit you will get, and corporate tax payment whatever the relevant within 9 months you have to pay the relevant tax. So another thing, tax basic, withholding tax credit, then foreign tax credit. So withholding tax credit means whatever domestic and cross-border payment between non-resident, if you are paying something, then you have to deduct 9. If it is, for example, withholding tax is more than 0, that means 9% is declared. If that's the case, then whatever the domestic or cross-border payment, you will deduct 9%, then you will pay the amount to the amount to the respective person. So in that case, whatever the amount withholding tax credit you will get. What is the foreign tax credit? So tax collected and paid to the government. So withholding tax is a tax collected and paid to the government. So basically, it will be UAE will be treated as a resident country. Automatically, whatever the payment to the respective domestic people or non-resident person, they will get it. As of now, 0%. And whatever the carry forward portion, it is applicable for whatever withholding tax credit. And what about foreign tax credit? Foreign tax credit cannot exceed amount of tax due, maximum of 9%. For example, UAE tax is a 9%, and another country foreign they have paid 15%, then you will get maximum deduction of 9%. Corporate tax refund, Article 49, withholding tax credit exceeds the taxable person corporate tax payable. That means the first slide we have discussed about the corporate tax credit. In that case, exceed whatever the amount available, that amount you will get a refund. Or second cases, if you are paid in excess of a tax payable, then that amount you will get tax refund or any other procedure performed by the ministry. For example, we'll see two examples. Taxable income. This is just assume that it is after deducting 375K. So case scenario 1, it's 800,000. Taxable income in a foreign country, it's 200,000. Global income 1 million. Tax rate 9%. For example, foreign tax rate it's 25%. Then UAE global income, it's 9% on 1 million. Then UAE tax on foreign income, 200,000 into 9%, 18,000. Then tax paid on foreign income. Foreign income, it is a 25%. 25% on 200,000. So already tax paid 50,000 tax paid in the respective foreign country. For example, if you take a UK, you have paid a tax out of 50,000. Then tax relief, whichever is lower. So 50,000 or 18,000. So you will get a relief of 18,000. That means subject to maximum of 9%, you will get a relief. Foreign tax credit. So total tax payable 90,000 minus 18,000, you have to pay 72,000. So total tax outflow, you have to pay 72, 122. How it is that 72 plus 50. So total outflow. So what is the tax credit loss? 32,000, because you have already paid 50,000. Out of this, only 18,000 only you will get a relief. Because what's the reason? It's up to 9% you will get a relief. That is called a foreign tax credit. This is not applicable to withholding tax credit. This is a foreign tax credit. In the case scenario 2, for example, you just take the similar example, 800,000, then 200,000, and global income is 1 million, then tax rate is 15%. This is, for example, it's not introduced MNC companies. It's like, let's say 15%. If that's the case, and the tax rate in foreign state, it is 7%. Foreign state is 7%. So global tax income, it's 150,000. It's 1 million into 15%. Then tax on foreign income, 30,000. Tax on foreign income is 30,000. Then foreign tax paid on foreign income, 14,000. That is 7% into 200,000, 14,000. And total 136 is a total tax payable. That means 150,000 minus 14,000, 136. Total tax outflow 150. Whether any tax credit loss, there is no tax credit loss, because its percentage it is less. So next, these are the main DTA relief, foreign tax credit, then withholding tax and everything. We have already discussed the withholding tax. As of now, it is 0%. Then 0%. And foreign tax credit we have already discussed. So next webinar we are planning to discuss about the transfer pricing and other topics, and we'll update everything in our LinkedIn. What will be the next webinar series and everything? You can just log into that one. And once you are fine with, once you are registered, then automatically you will get a link and everything. So if you like this, our webinar series, please share your reviews and everything. You can just take Google review from here. It's you can use your mobile phone and you can use. And in case if you have missed our previous webinar, you can see the webinar series 1 and webinar series 2 and webinar series 3. You can just watch, then you'll get an idea about what exactly the qualifying free zone, and one is relating to connected person. Then first category, it is related to the basics, basically relating to residency-based taxation and the source-based taxation. These are the things that discussed in the webinar 1 and webinar 2 and webinar 3. So to understand this DTA concept in detail, so you have to just understand the basic things, then you will get an idea. Yes. Thank you for joining this webinar. Have a wonderful day.